3 million Silverados flooding the market. Dealers desperate to clear inventory at any price. Factory lines grinding to a halt while trucks sit collecting dust on overflow lots from coast to coast. What General Motors hoped would remain their quiet crisis has just exploded into the open, creating the biggest fire sale in American truck history, and transforming vehicles that once commanded five-figure premiums into depreciating liabilities that dealers can't give away fast enough. I've spent the past 3 weeks investigating the massive inventory pileup that's sending shockwaves through the automotive industry. After speaking with 19 dealer principals, 6 regional sales managers, and dozens of industry insiders, the truth is clear. Chevy's Silverado collapse is just the beginning of a market meltdown that will reshape truck values nationwide and potentially save you tens of thousands, if you know how to play this once-in-a-generation opportunity. Why are trucks that commanded markups just months ago now being dumped at losses? What triggered GM's panic selling across their entire truck lineup? And how can you leverage this historic price collapse to potentially save $20,000 or more on your next purchase? Let me show you what's really happening behind the sale banners and desperate advertising, and why industry insiders are calling this the biggest buyer's market for trucks in 30 years. The backlot crisis no one was supposed to see. The first sign of trouble appeared not in industry reports or corporate announcements, but in satellite images capturing something dealers couldn't hide: massive overflow lots filled with thousands of unsold Silverados baking in the sun. Drive past any Chevrolet dealership's main showroom and everything looks normal. But venture behind the service department, check the remote storage lots, or visit the auxiliary properties many dealers have quietly leased in recent months, and the true scale of the crisis becomes clear. "We're sitting on triple our normal truck inventory," admitted a sales director at a major Chevrolet dealership in Texas who requested anonymity to speak freely. "Corporate keeps shipping them, the bank keeps charging us floor plan interest, and customers keep delaying purchases. It's the perfect storm." At another high-volume store in the Midwest, the situation has become desperate. "We've got 98 new Silverados in stock right now," the general manager explained. "Our target is 35. We're paying interest on millions in excess inventory that's losing value by the week." The overflow has become so severe that dealers are renting additional storage lots miles from their showrooms, creating hidden stockpiles of unsold trucks that executives hope customers never see. A commercial real estate broker in Oklahoma confirmed he's leased 3 separate properties to local GM dealers specifically for excess truck storage, deals completed with unusual confidentiality requirements. This unprecedented inventory glut didn't happen by accident. It's the result of a perfect storm of market forces, corporate miscalculations, and economic shifts that have transformed America's best-selling vehicles into financial liabilities almost overnight. Have you noticed empty dealer lots being replaced with overflowing inventory? Comment with your zip code and what you're seeing locally. And if you think the visible inventory is concerning, wait until you see the desperate financial measures dealers are taking to move these trucks before values collapse even further. Price collapse. Move metal at all costs. The clearest evidence of panic isn't the crowded lots. It's the pricing collapse happening in real time across Chevrolet's truck lineup. Models that commanded $5,000 to $10,000 markups just 18 months ago are now being advertised at thousands below invoice, with even deeper discounts available for buyers willing to negotiate. "The directive from corporate is crystal clear," revealed a regional sales manager for a 6-store Chevrolet group in the Southeast. "Move the metal, regardless of profit. Cash flow is all that matters now." This desperation is manifesting in unprecedented discounts that would have been unthinkable during the inventory shortages of 2021 and 2022. 0% financing extended to 84 months, effectively interest-free loans for 7 years on depreciating assets. Customer cash rebates reaching as high as $12,000 on higher-trim Silverado models. Direct subsidies that slash profits to move aging inventory. Bonus cash incentives stacked on top of advertised discounts, often revealed only when customers are close to walking out. Dealer holdback money, normally sacred profit reserves, being sacrificed to close deals. Employee pricing programs extended to virtually any buyer, eliminating the traditional negotiation process entirely. The numbers tell the story. According to industry tracking data, The average transaction price for a new Silverado 1500 has plummeted nearly 18% since January, with high-end trims like the High Country and ZR2 seeing even steeper declines. For buyers, this translates to savings of $15,000 to $25,000 compared to peak pricing just 18 months ago. "We're selling trucks below our actual cost," confirmed a dealer principal from a high-volume Chevrolet store in California. "When you factor in floor plan interest, preparation costs, and overhead, we're losing money on most Silverado deals right now. But holding inventory is even more expensive." The collapse is particularly evident in the widening gap between MSRP and actual transaction prices. Trucks that once sold for thousands over sticker are now changing hands for 15 to 20% below the window price, a swing of nearly 30% in total pricing power. This isn't normal seasonal discounting or model year clearance. It's a fundamental revaluation of assets that signals deep structural problems in both production planning and market demand. And for consumers willing to act decisively, it creates a buying opportunity that comes perhaps once in a generation. Have you been offered shocking discounts on a Chevy truck recently? Share the details and your location in the comments below. But the inventory crisis and price collapse didn't occur in isolation. They're symptoms of larger forces converging simultaneously to crush truck values. Forces that General Motors executives apparently never saw coming. The perfect storm. Why 3 million trucks hit at once. The Silverado collapse wasn't triggered by a single misstep, but by multiple factors converging into what industry analysts are calling the perfect supply storm, a once-in-a-generation alignment of market forces all pushing in the same disastrous direction. First came the lease tsunami. During the inventory shortages of 2021 and 2022, leasing companies locked in historically high residual values for Silverados, betting that strong demand would continue indefinitely. Those 36-month leases are now reaching maturation, flooding auction lanes and dealer lots with nearly new trucks at precisely the moment retail demand has softened. We're seeing 2 to 3-year-old Silverados with low miles coming back from leases at volumes we've never experienced, explained an auction manager at one of the nation's largest wholesale vehicle marketplaces. Volume is up 300% year over year, and there simply aren't enough buyers to absorb them. The second wave hit from fleet returns. Rental companies and corporate fleets that stocked up on trucks during the post-pandemic travel boom are now cycling out those vehicles as maintenance costs rise and newer models become available. These former fleet trucks, often well-equipped models with moderate mileage, are competing directly with both new inventory and lease returns, creating a three-layer glut across every price point. The third and most damaging factor came from GM's own production decisions. Despite early warning signs of softening demand, General Motors continued running Silverado production at full capacity through the first half of 2025, flooding an already saturated market with even more inventory. It's basic supply and demand, but someone at corporate wasn't paying attention, noted a former GM production planning executive who recently left the company. They were still operating on the shortage mindset of 2021, trying to build as many high-margin trucks as possible without recognizing that the market had fundamentally shifted. Internal forecasting failures appear to have played a critical role. According to sources familiar with GM's planning process, production schedules for Silverados were locked in based on optimistic sales projections that failed to account for rising interest rates, increasing fuel costs, and changing consumer preferences. By the time the inventory buildup became impossible to ignore, the pipeline was already filled with hundreds of thousands of trucks committed to production, vehicles that would arrive at dealerships already steeply devalued. This convergence of lease returns, fleet disposals, and overproduction created what one analyst described as the mother of all supply gluts, a situation where even dramatic production cuts can't prevent further price erosion as the market struggles to absorb the existing overflow. Have lease returns or fleet sales impacted truck prices in your area? Drop your zip code and local observations below. While the inventory glut and production miscalculations created perfect conditions for a price collapse, another factor accelerated the crisis and sent buyer confidence into freefall. Confidence killer, the reliability investigation. As if the supply glut wasn't damaging enough, Chevrolet's truck values were hit with another devastating blow when the National Highway Traffic Safety Administration opened a formal investigation into engine failures affecting certain Silverado models equipped with the 5.3 and 6.2-liter V8 engines. The investigation focused on reports of premature engine failure linked to the active fuel management system, sent shockwaves through both dealer networks and consumer confidence. While the probe currently covers a limited number of model years, the perception damage has spread across the entire Silverado lineup, accelerating price declines even for unaffected models. The timing couldn't possibly be worse, explained an industry analyst specializing in automotive market trends. Dealers were already drowning in inventory, and now they're trying to sell trucks that customers are reading negative headlines about. It's a confidence killer at the worst possible moment. The investigation focuses on reports that active fuel management lifters are failing prematurely, causing catastrophic engine damage that typically manifests just after warranty coverage expires. Repair costs often exceed $10,000, creating a perception of financial risk that many buyers are unwilling to accept regardless of discounting. Dealers report that customers are arriving with printouts of NHTSA complaints, using the investigation as leverage to demand even deeper price cuts on both new and used Silverados. Many buyers are avoiding the affected models entirely, further concentrating demand on a shrinking subset of the already oversupplied market. We've had customers walk in, ask specifically if a truck has active fuel management, and walk right back out when the answer is yes, said a sales manager at a Midwest Chevrolet dealer. No amount of discounting can overcome that kind of reputation damage. The investigation's impact extends far beyond the specific models under review. By creating uncertainty about the entire Silverado lineup, it has accelerated the inventory crisis and forced dealers to offer even more aggressive discounts on all trucks. A desperation move that signals deeper problems than GM publicly acknowledges. For buyers willing to accept the potential reliability concerns, however, this crisis of confidence creates extraordinary leverage in negotiations, with some dealers reporting discount conversations starting at 20% below sticker before any serious haggling begins. Have concerns about Chevy truck reliability affected your purchasing decisions? Share your thoughts in the comments below. But the most revealing evidence of GM's desperation isn't happening on dealer lots. It's taking place in wholesale auctions where the true market value of these trucks is being exposed in real time. Auction collapse. The hidden price freefall. While retail prices for Silverados have fallen dramatically, the true scale of the value collapse is most visible in the wholesale auction market, where dealers send excess inventory and lease returns for liquidation. These auction prices, hidden from most consumers, reveal the financial crisis unfolding behind closed doors. I've been running dealer auctions for 27 years, and I've never seen anything like what's happening with full-size trucks right now, revealed an auction director who oversees sales in 3 Midwestern states. Silverados that would have commanded strong money 18 months ago are selling for 60 to 70 cents on the dollar today, if they sell at all. The numbers are staggering. Late-model Silverado 1500 crew cabs with low mileage, configurations that typically hold value better than most vehicles, are selling at wholesale for 25 to 35% below projected values. High-end trims like the High Country and LTZ are experiencing even steeper declines, with some crossing the auction block at barely 50% of their expected value. This wholesale collapse creates a cascading effect through the entire truck market. As auction values establish new, lower benchmarks, retail prices must follow. Trade-in values plummet accordingly, often leaving current Silverado owners underwater on loans for trucks purchased during the high-price period of 2021 and 2022. We had a customer bring in a 2022 Silverado High Country they paid $67,000 for last year, explained a used car manager at a large dealer group. We could only offer them $41,000 on trade today. They were shocked. But that's where the market is now. We have to price based on what these trucks are bringing at auction, and those numbers keep falling. The situation has become so severe that some auctions are imposing limits on the number of Silverados a dealer can send through in a single week, an attempt to prevent further market flooding that would drive values even lower. Others are creating special truck-only sales events to concentrate buyer interest on the overwhelming supply. For consumers, this wholesale collapse creates both opportunity and risk. Buyers who understand the true market dynamics can negotiate far more aggressively, using wholesale values as leverage to secure deeper discounts. But current Silverado owners face accelerating depreciation that may leave many owing thousands more than their trucks are worth. Have you checked your truck's current value recently? Comment with your model year and how much value you've lost. While market forces are driving much of this crisis, GM's response has revealed a corporate strategy focused on protecting short-term profits at the expense of long-term value stability, an approach that may further damage Silverado's market position. Factory response: the production pause gambit. As inventory swelled and values plummeted, General Motors finally took the step many industry analysts had been expecting for months: production slowdowns at key Silverado manufacturing facilities. These temporary adjustments, corporate speak for emergency production cuts, represent a belated acknowledgement of the market reality GM executives had been reluctant to face. Plants in Fort Wayne, Indiana, Flint, Michigan, and Silao, Mexico have all experienced what GM officially terms production schedule adjustments in recent months. Temporary shutdowns lasting 1 to 2 weeks that reduce output without the negative publicity of permanent shift eliminations or layoffs. The Fort Wayne plant was offline for 8 days last month, confirmed a supply chain manager who works with multiple GM facilities. They're calling it routine maintenance, but everyone knows it's about slowing production to let dealers clear inventory. We've been told to expect more adjustments throughout the remainder of the year. These production pauses serve multiple purposes. Beyond the obvious benefit of slowing the flow of new trucks into an already saturated market, they allow GM to avoid the negative optics of permanent production cuts while preserving the option to quickly resume full capacity if market conditions improve. The strategy also shifts much of the financial burden onto suppliers and workers rather than corporate balance sheets. Temporary shutdowns often mean reduced hours and income for plant workers, while suppliers must absorb the costs of production disruption without the benefit of formal contract renegotiations that would accompany permanent capacity reductions. It's a way for the company to preserve flexibility while forcing others to absorb the pain, explained an automotive industry labor analyst. By using temporary pauses rather than permanent cuts, they keep their options open while transferring the financial impact to workers through reduced hours and to suppliers through irregular ordering patterns. Despite these production adjustments, dealers report that inventory continues to accumulate faster than sales can absorb it, suggesting that even more dramatic production cuts may be necessary to rebalance the market. Some industry observers believe GM has been reluctant to make deeper cuts due to concerns about losing market share to Ford and Ram during a period of transition. The most telling aspect of GM's production strategy is what they haven't done: announced any permanent reduction in Silverado manufacturing capacity. This suggests either extraordinary optimism about a market recovery or deep concern about acknowledging the structural nature of the current oversupply problem. For consumers, these production pauses offer a clear signal that the pricing environment will remain favorable for buyers in the near term, as GM struggles to bring supply into alignment with reduced demand. The longer these temporary adjustments continue, the stronger the bargaining position for truck shoppers. What do you think about GM's production pause strategy? Share your thoughts in the comments below. Beyond the immediate crisis in dealer lots and auction lanes, Chevy's truck collapse is triggering broader consequences that will reshape the entire pickup market for years to come. Beyond Chevy, how the Silverado collapse is reshaping the truck market. The Silverado's price collapse isn't happening in isolation. As Chevrolet slashes prices to move inventory, competitive dynamics are forcing other manufacturers to follow suit, creating a cascading effect that's reshaping value propositions across the entire truck segment. Ford dealers report increasing pressure to match Chevrolet's aggressive discounting, particularly on F-150 models that compete directly with the Silverado. While Ford's inventory situation appears somewhat better managed, the market expectations set by Chevy's fire sale pricing are forcing comparable discounts to maintain sales volume. We don't have nearly the inventory problem Chevy has, but we still have to respond to their pricing, explained a Ford dealer principal from the Southeast. When the Silverado buyer can get 20% off, we have to be in the same neighborhood or we lose the sale. It's pulling down values across all truck brands. Ram dealers face similar pressures, with the Stellantis brand caught between protecting profit margins and maintaining market share. Recent redesigns had positioned Ram as a premium alternative in the full-size truck segment, but that strategy has become increasingly difficult to sustain as Chevrolet's discounting drags the entire market downward. Toyota and Nissan, with smaller but significant positions in the full-size truck market, are experiencing the competitive spillover as well. Tundra and Titan models that once commanded strong values based on reliability reputations are now facing price compression as the domestic brands slash prices to move metal. The ripple effects extend to the used truck market, where values are collapsing even more dramatically. Late-model used Silverados have seen average retail prices fall by 25 to 30% in just 12 months, pulling down values for F-150s, Rams, and other competitors in the process. This market-wide revaluation creates both winners and losers. Consumers shopping for trucks benefit from the most buyer-friendly pricing environment in decades, with unprecedented leverage in negotiations. Current owners, however, face accelerating depreciation that may leave many owing more than their trucks are worth, particularly those who purchased at peak prices with minimal down payments. Fleet operators who traditionally rely on strong residual values to manage total cost of ownership are being forced to extend replacement cycles or accept greater losses on vehicle turnover. This hesitation among fleet buyers further reduces demand in an already oversupplied market, potentially extending the price correction period. The long-term consequences may be even more significant. As manufacturers slash prices to move current inventory, they're effectively resetting consumer expectations about what trucks should cost. Once buyers become accustomed to substantial discounts, returning to full margin pricing becomes extraordinarily difficult, a challenge that may reshape product planning and pricing strategy for years to come. Has the truck price war affected values of other vehicles in your area? Share your observations and zip code below. For consumers navigating this rapidly evolving market, understanding the perfect timing and approach can mean the difference between a good deal and an exceptional one, particularly as year-end targets add further pressure to dealer operations. Buyer's Playbook: How to Save $20,000 plus in today's market. For consumers willing to act strategically, the current truck market presents a once-in-a-generation buying opportunity. By understanding dealer psychology and market dynamics, buyers can leverage the Silverado collapse to secure extraordinary savings on both Chevrolet products and competing brands. The most effective negotiating strategy begins with timing. As dealerships approach month-end and quarter-end targets, desperation to move units intensifies. A purchase negotiated during the last 3 days of the month typically yields savings $3,000 to $5,000 greater than the same deal attempted mid-month, a difference that directly reflects mounting pressure on dealers to hit factory-mandated volume numbers. The last week of the month is when managers start making truly irrational decisions, admitted a sales director who oversees 6 Chevrolet dealerships. By that point, we're often willing to lose thousands on individual units just to hit volume bonuses that pay tens of thousands. Smart customers who understand this leverage it mercilessly. Year-end timing creates even greater opportunity. As dealerships approach December 31st, the pressure to clear aging inventory reaches its peak. Trucks that haven't sold by mid-December often represent both a tax liability and a depreciation risk for dealers, creating motivation to accept offers that would be rejected earlier in the year. Beyond timing, information arbitrage provides exceptional leverage. Buyers who arm themselves with wholesale auction data, available through various online services or from transparent used car retailers, gain insight into dealers' actual cost basis. This information allows for first offers well below traditional starting points, often shocking salespeople accustomed to working up from sticker price rather than down from actual market value. Cross-shopping between competing brands amplifies negotiating power. A buyer who obtains a written offer on a discounted Silverado can use that documentation to extract similar concessions on an F-150 or Ram 1500, effectively leveraging Chevy's desperation against its competitors. Many dealers will match or beat offers from across town simply to prevent losing a unit in today's volume-focused environment. The most successful buyers are employing a multi-phase approach, securing a competitive offer from one dealer, using that as leverage with another, then returning to the original dealer for further concessions. This triangulation strategy can extract an additional $3,000 to $5,000 in savings beyond initial discount offers. For those willing to consider nearly new alternatives, the opportunity grows even larger. Off-lease and former rental Silverados with under 30,000 miles are selling for 40 to 50% below their original MSRP. Discounts that translate to savings of $25,000 or more compared to purchasing new just 18 months ago. Most importantly, buyers should recognize the psychological advantage they currently hold. Dealers facing mounting inventory, floor plan interest, and pressure from manufacturers are negotiating from a position of weakness unprecedented in recent market history. Offers that might have been considered insulting a year ago are now starting points for serious discussion. What negotiation tactics have worked for you in the current market? Share your success stories below. But the implications of Chevy's truck collapse extend far beyond individual buying opportunities. They signal deeper structural changes in American transportation preferences and manufacturing strategy. The bigger picture, what this means for the future of trucks. Beyond the immediate pricing crisis, Chevrolet's truck collapse reflects fundamental shifts in the American automotive landscape, changes that will reshape product planning, manufacturing investment, and consumer options for years to come. The most significant long-term implication is the apparent end of the truck-dominant era in American vehicle preferences. For nearly 3 decades, full-size pickups have represented both the highest volume and highest margin segment of the domestic market. Manufacturers responded by allocating disproportionate development resources and production capacity to these profitable vehicles. That strategy now appears increasingly risky as multiple factors converge to challenge truck dominance. Persistent high fuel prices have shifted buyer preferences toward more efficient options, including smaller trucks, crossovers, and hybrid/electric alternatives. Urbanization continues to reduce the practicality of full-size trucks for many Americans, with limited parking and maneuverability creating practical barriers to ownership in growing metropolitan areas. Changing work patterns, accelerated by remote and hybrid arrangements, have reduced the daily commuting use case that justified many lifestyle truck purchases. Rising interest rates have dramatically increased monthly payments on high-priced vehicles, pushing many potential truck buyers toward more affordable segments. These structural shifts suggest that the current inventory glut isn't merely a temporary imbalance, but potentially the beginning of a long-term realignment of production capacity with genuine market demand. If true, the implications for manufacturing communities dependent on truck production could be severe and lasting. General Motors' reluctance to implement permanent production cuts reflects the enormous capital investment tied up in Silverado manufacturing facilities. Plants in Fort Wayne, Flint, and Silao represent billions in specialized equipment and decades of infrastructure development, assets that cannot be easily repurposed for other vehicle types without massive additional investment. The company faces difficult strategic choices: maintain truck production capacity in hopes of a market recovery, implement painful permanent reductions, or accelerate the transition toward electric and autonomous vehicles that represent the industry's future but currently generate minimal profits. For consumers, these industry dynamics create both opportunity and uncertainty. The short-term pricing environment for trucks will likely remain extraordinarily favorable as manufacturers struggle to align production with reduced demand. However, the long-term availability of certain configurations and options may decrease as companies rationalize product offerings to reduce complexity and costs. The truck market's evolution also signals potential shifts in American manufacturing employment, community stability, and economic development patterns. Regions heavily dependent on truck production may face challenging transitions as automation increases and overall production volumes potentially decline from historical peaks. What changes have you noticed in truck popularity in your area? Are fewer people driving full-size pickups? Share your observations below.